A very happy morning to all of you and welcome to the YouTube channel Banking Fundas. In today's module, we're going to take a look at APR or the annual percentage rate. Many times we buy products by using consumer financing. We take a loan from a bank or from an NBFC, or sometimes we might even take a loan from BNPL companies, that is your buy now, pay later companies. And now we also have a fourth option, that is the option of borrowing from P2P, peer to peer, digital lending platforms. We get enticed and attracted by the low rates of return, low rates of interest that is charged on some of these loans. But actually, what is the true cost of this loan to you as a borrower? That is APR or annual percentage rate. In this module, we're going to take a look at what are the building blocks for APR and understand what is APR, APY, as well as concepts of simple interest and compound interest. APR, APY, and interest. Banks are in a very interesting business, and that interesting business is that of taking deposits either by way of CASA accounts, CASA standing for current account and savings accounts, or RAFA accounts called as recurring accounts and fixed deposit accounts. These four categories of deposits, that is current accounts, savings accounts, recurring accounts, as well as fixed deposit accounts, that is four categories of deposits, are the primary source of deposits for the bank. What does a bank do with all these deposits that they collect? The bank gives it to individuals who need loans to buy houses, who need loans to buy vehicles, or who take loan against gold, loan against shares, personal loans, educational loans. All these come under the category of retail loans. But a bulk of the deposits are given to corporates for meeting their working capital requirements, for their project financing requirements, for their bill discounting activities. So from this slide, we understand that banks pay interest on all the deposits and they earn interest on all the loans. So banks are always looking to maximizing interest earned on the loans and minimizing interest expenditure on the deposits. Let's start with the basics. The basics is simple interest, which we have learned sometime in 9th grade or 10th grade, or maybe even earlier. Simple interest is earned and paid every year. So simple interest is not just a mathematical calculation, it is also a cash flow from the bank to the depositor. The formula for simple interest is really very simple. It involves multiplying three variables: principal, P, R, rate of interest, and N, number of years. We multiply these three variables, and because R is a percentage, we divide by 100 to get a rupee denominated simple interest for the year. Let's take an example with my favorite character from Marvel comics, that is Doctor Strange. Well, you will be seeing Doctor Strange a lot in many of my examples. Well, because I'm a fan. Doctor Strange opens a savings account with Marvel Bank. The second point is the account has an average balance of $1 million and Marvel Bank pays an interest at 4% per annum. We have got the data points till now. Let us understand the data points. Dr. Strange is a depositor. Marvel Bank is the bank. The principal amount is $1 million and Marvel Bank pays interest at 4%. So if you're ready for your mathematical calculations, either keep a calculator ready or you can open up your Excel sheet. Dr. Strange's example with Marvel Bank, the principal amount is $1 million. The interest rate is 4% per annum. Using the formula P multiplied by R multiplied by N divided by 100, we get simple interest of $1 million multiplied by 4% multiplied by 1 year. That gives us simple interest of $40,000 per annum. This implies that Dr. Strange earns $40,000 and will also receive $40,000 within a year from the date of starting the account. Okay, so this is a computation of simple interest. If the interest is paid quarterly, then the same interest formula we are going to use for simple interest, except that we are going to de-annualize it to make it a quarterly payment. We'll now take an example of compound interest, which is the basic thumb rule for investing, especially for long-term investors. The joys of compounding are limitless, unlimited. Compound interest is interest that is earned at predetermined intervals, but it is paid only on maturity. So if it is earned, what happens to it? It gets reinvested. Okay, and reinvestment is the most basic rule of wealth maximization. Compounding is the way that people actually create wealth for themselves. So, what is the difference between simple interest and compound interest? Simple interest, on the first factor, which is interest paid, simple interest is paid annually, whereas compound interest is paid on maturity. Both are earned from day one, but simple interest is paid out. Compound interest is paid only on maturity. On the second factor, cash flows, simple interest is paid by the bank to the depositor every year, but principal is repaid only on maturity. In compounding products, there is only one cash flow, that is on maturity. Okay, so simple interest and compound interest differ only on these two parameters. Compound interest calculation, let's go back to Dr. Strange. Let's take an example. He opens a term deposit of $5 million for a period of 3 years. Marvel Bank pays interest at 4% per annum. Calculate the maturity value of the term deposit. So compound interest calculations, you can either use future value, present value calculations on Excel, or you can use the formula of compound interest, which is directly the amount multiplied by 1 plus r raised to the power of n. Let's look at this example. I calculated on Excel. We'll first take a look at scenario 1. The principal amount is 50 lakh rupees, $50 lakh, I'm sorry. The rate of interest is 4%. The number of terms is 3. All I did to find out the repayment value is go to Excel and use the function of future value. Or you can do it on your scientific calculator also. A is equal to P open bracket 1 plus R divided by 100 raised to the power of n. The repayment amount comes to end of 3 years. Dr. Strange gets $5.6 million or 56 lakhs in his account. In these 3 years, there is no cash flow between the bank and Dr. Strange. That is very important to remember. In the second scenario, the principal amount is the same, but the compounding frequency has increased to semi-annual. So the rate of interest, which was 4% per annum, is now semi-annualized to 2% per annum because the compounding frequency has increased from 1 year to twice in a year. The number of terms has now multiplied. So in 3-year time slot, you will have six half-yearly payments, right? But here there is no payment, but there's only a earning. So the repayment amount is principal amount multiplied by the rate of interest 1 plus R. We realize from here that Dr. Strange is getting extra money because the compounding frequency has increased. Similarly, if the compounding frequency increases to quarterly payments, it will be even higher. So as long as the depositor keeps the money locked in, interest gets reinvested. It is not paid out to the depositor, wealth accumulates. And this is how compounding takes place. Now that we have understood the building blocks of simple interest and compound interest, let us take a look at APR, or annual percentage rate. Annual percentage rate is a broader measure of the cost of borrowing money. When I saw what is added to interest cost, in some sites they add processing fees, in some other sites they add transaction charges. So I've just consolidated everything and written processing fees plus transaction charges plus insurance and other costs. Let's take a look at how APR works. Dr. Strange takes a personal loan of $100,000 with a repayment of over 5 years. Okay? The interest rate is 10% per annum. The processing fees are 1.5%. Now, these processing fees are only charged once in the entire 5 years. It's not an annual expenditure. The next cost that is added to this is the insurance costs, which is mentioned over here as 2,500. Insurance by its very nature is an annual expenditure. So even though nothing is mentioned over here, insurance costs will be tabulated as annual expenditure. So from these three expenses, that is interest rate, processing fees and insurance costs, two of them are recurring in nature, that is interest and insurance. One of them is only a one-time expenditure, that is processing fees. Using this data, we will calculate the APR, or the annual percentage rate. The first item over here is the principal amount, which is 1 lakh, 100,000. The interest rate is 10%. This data point is given to us. The number of years is 5 years. The fourth is 1.5%. As already mentioned to you, it's a one-time expenditure. The insurance costs is 2,500, which is repeated every year. Now let's calculate the APR. Step 1. Interest expense per annum is 10,000. Okay. How did we get 10,000? 1 lakh multiplied by 10%. What is the interest expenditure over 5 years? The interest expenditure over 5 years is 10,000 multiplied by 5, which gives us 50,000. What is the processing fees? Processing fees is only one time. That is 1 lakh multiplied by 1.5%, we get 1,500. The insurance costs over 5 years is 2,500 multiplied by 5 gives us 12,500. So now we are going to calculate what is the expenditure over the 5-year period. That is calculated as total costs over the 5 years. This includes 50,000 interest expenditure plus processing fee 1,500 plus 12,500 of insurance. If we add these three numbers together, we get the total cost over the 5 years as 64,000. But interest rates are not calculated for a 5-year period. They are always calculated as a percentage per annum. How do we do that? 64,000 is your total cost divided by 1 lakh, right? How many days are there in 5 years? 365 multiplied by 5. We get the annual expenditure of this loan as 0.00035. Okay, repeating myself. The total costs 64,000. The principal amount is 1 lakh. Yes, but 64,000 is for 5 years. So now we have to calculate per day what is the cost. For that, we have to calculate per year. There are 365 days. So for 5 years, the expenditure is 64,000 divided by 1 lakh. Divided, the sum is then, the dividend is then divided by 365 multiplied by 5. That we get as 0.00350685. Now we have to percentage it. How do we percentage it? Now, this is the expenditure per day of the loan. 0.000350685 is the expenditure per day. We have to find out per annum. We therefore multiply this by 365. We get the per annum cost as 12.80%. Now this is remarkable. You thought the interest rate is 10%, you thought it was attractive. But actually the total cost for you is 12.80. And that is why whenever you're taking a loan, remember to calculate the APR of the loan. APY is the annual percentage yield. This is the returns that a depositor earns on fixed deposits or recurring deposits. Interest is reinvested at predetermined intervals, interest is compounded, and therefore APY is the same as compound interest. How do banks use these concepts? Okay, simple interest, compound interest, APR, APY, etc. We'll see now. Savings account, interest is calculated on simple interest. Mortgage loan that you take for a home, the interest is calculated at APR. RD, recurring deposit, it is compound interest or APY. Fixed deposits, compound interest or APY. So thus in this module we have taken a look at different concepts of interest rate. We have not yet looked at different types of interest rate, which we'll be doing in a separate module, but these concepts are very useful for you to understand how your bank is doing with respect to lending and borrowing money. Thank you so much for listening into this channel. If you like the content, share. If you like the content, subscribe. If you have any queries, please post it on the comments. Thank you so much.